Good afternoon, ladies and gentlemen. Welcome to Bank Millennium Conference after first quarter results. We have today with us Chairman of the Management Board, Mr. João Brás Jorge. We have Deputy Chairman, CFO, Mr. Fernando Bichu. We have also Grzegorz Maliszewski, Chief Economist. My name is Artur Kulesza. I am Head of Investor Relations. And as usual, we start with short presentation, followed by Q&A session. So I give the floor to CFO, Mr. Fernando Bichu.
Hello, good afternoon, and thank you for attending this conference. I will start with the brief macroeconomic overview. If you look at page number 4 of our presentation, we can see that we continue to live in a record low interest rate environment. Interest rates in Poland remained relatively stable during the first quarter of this year. A slight decrease of the WIBORs, but let's say, especially when compared with previous periods, a relatively stable environment. Also we faced some steepening of the yield curve of the Polish government bonds, with on one side the short end of the curve supported by still some rate cut expectations, and also the fact that Polish treasury bonds are exempted from the banking tax, and on the other side the long end of the curve more subject to other factors and more volatile markets, and also connected with the monetary policy in the US and in the Eurozone. Looking at page number 5, the macroeconomic environment in Poland continues to be positive and supportive. Especially on the more positive side, we have to stress the conditions in the labor market which are the best since 2008. We have the lowest unemployment rate since 2008, and also still continuation of deflation. In terms of prospects for economic growth, still relatively stable, with the expected GDP growth hovering between 3.5–3.8% during the current year. In terms of FX market, a little bit more volatile, but still, when compared with the end of the previous quarter, we can say that the main FX rates were relatively stable. In terms of monetary aggregates on page number 6, we see still the solid growth of deposits in the Polish banking system, both from the households growing at a yearly rate of almost 10% year on year, and corporate deposits also growing at 8% year on year, while we can see some deceleration of the growth of corporate loans. It's still probably a little bit too early to say if this is a new trend of having slower growth, but truly the first quarter showed some deceleration of the yearly growth. And in household deposits, excluding FX impacts, the growth rate relatively stable at around 4% year on year. So against this backdrop of macro environment, we had I would say a good result in the first quarter. The highlights are in the page number 8. We finished the first quarter of the year with a net profit of 137.2 million zlotys, already after the new banking tax. Excluding this tax, the result would have reached 169.5 million. Return on equity at 8.4%, or 10.4% without the new tax. We managed to keep a stable cost-to-income ratio at around 50%, similar to the level of 1 year ago and to the average of last year, excluding one-offs. And in an environment where we had a slight drop both of operating income and of operating costs by around 1%. We showed improvement in the ratio of impaired loans to 4.5%, and keeping very low ratio of impaired mortgage at 2.1%. The cost of risk was relatively low at 38 basis points over total net loans, which is a level which is very similar to the previous quarter and lower by 22 basis points versus the first quarter of last year. We further strengthened our capital ratios. We finished the quarter with a total capital ratio at the consolidated level of 17.2% and Common Equity Tier 1 ratio at 16.8% already after the shareholders meeting final decision of retention of the full profit of 2015. And in terms of liquidity, stable with a very low loan-to-deposit ratio at 88%. Moving now to page number 9, we see that without the banking tax, we would have had a growth of the net profit year-on-year of 4.2%. We paid for the first time banking tax 2 months in the first quarter, total amount of 32.3 million, non-tax deductible, and so if we would not consider this impact, the net profit would have reached 169.5. After this tax, net profit reached 137.2 million, which is 15.6% below the first quarter of last year. In terms of operating income, we faced a small drop by 1% year-on-year, mainly due to a decrease of core income by 1.7% year-on-year due to lower commissions, as I will explain later on. Looking at the net interest income, we continue to show a gradual rebound from the lowest level that we reached in the second quarter of last year after the rate cut that took place in March 2015. So when we look year on year, we had a growth of net interest income on a pro forma basis of 3.9%. And also a relevant improvement of net interest margin by 6 basis points in the quarter to 2.28%, which is already slightly above the level of NIM in the first quarter of last year. This level was supported by improvement in the cost of the deposits that fell by 28 basis points year on year and 6 basis points quarter on quarter. Moving to other income, we had a drop of commissions in the first quarter of this year of 14% versus 1 year ago, mainly due to 2 reasons. First, lower fees from investment products, investment funds, due to very poor beginning of the year in terms of the capital markets, which had the consequence of decreasing the overall stock and also much lower net sales of investment products. And the second factor was the high base of bank assurance fees that we booked in the first quarter of 2015. We are living now in a new environment after implementation of Recommendation U last year, after implementation of the new Act on Insurance this year, and so we are now facing this adjustment. Going forward, we should expect a gradual decrease of this negative evolution of commissions versus 1 year ago. Trading income was slightly better than 1 year ago by 4 million zlotys or 9%, supported by better results on transactions with corporate customers and also by gains realized on the available for sale bond portfolio. Moving to the cost side, we continue to keep our disciplined cost management. We decreased costs by 1% year on year, offsetting almost flat staff costs with lower admin and depreciation costs that were also supported by the gradual program of optimization of the branch network, which translated into further reduction in the number of branches, also some reduction in the number of employees, and so this allowed us, together with the evolution of operating income, to keep cost-to-income ratio at 50%, 50.4% in the first quarter, similar to the level achieved in the first quarter of last year and to the average of last year, in fact. In terms of asset quality, we had, versus the previous quarters, a slight improvement in the impaired loan ratio, supported by the sale of NPLs that we have done in the first quarter. The amounts are mentioned in the footnote to this slide number 13. And so, as you can see, we have been benefiting from gradual improvement of the quality of the corporate loan portfolio. Also, the other retail ratios improving after the sale of the NPLs, and mortgage relatively stable. As a consequence, we had the second consecutive good quarter in terms of cost of risk at 38 basis points over total net loans, similar to the fourth quarter of 2015, and 22 basis points lower than 1 year ago. The capital ratios of the bank and of the group continue to